Hi again, I'm Kortsch from the Monetary Trust Initiative. Hopefully if you watch all these sequentially immediately afterwards, it's going to drive you a bit crazy. But remember, I'm trying to bring 4 points together. Infrastructure, how to fund it, our monetary system, how it works, the rate of inflation, and the balance sheet of the Federal Reserve Bank. Okay, we're on the second point now, the monetary system. And in the last video, we talked basics and wrong concepts. What is it that 99% of the US and probably the world thinks as to how this actually works, and no, that is not how it works. I talked about the Fed creating our money by printing. No. QE is just printing. You get no. QE, quantitative easing, will lead to hyperinflation because the banks can just multiply this money up. No. And the banks intermediate. They take money from savers and give them on to lenders. No. Just a point on that. If you think about it, if the money comes from savers first, which is what basically everybody thinks, and is then lent on, how did those savers ever get the money? Or they earned it. Well, how did the company get the money that paid the salary to the savers? You know, it's one big circle. No, that's not how it works. And then the fifth point where we say, well, we're different. No, we're not. It's the whole world works that way. And then I ended up with a quote from the Bank of England on a paper just to say, you know, I have somebody else saying that what I'm telling you is actually the truth. All right, well, how does this actually work? That's kind of what most of this is all about. We live in what we call a fractional reserve banking system. Let's pick those words apart. First of all, fractional. It means there's only a fraction of the money that you think is in the bank is actually in the bank. It's a small fraction. That's why we have runs on the bank. When suddenly a whole bunch of depositors want their money back, well, the money isn't there. The money's not in the bank. So that's the fractional part. Then it's a fractional reserve banking. By the way, we're going to get back to that, okay? But this is an overview, first of all, then some details. What's a reserve? Well, a reserve is a combination of two things. It's cash in the vault of the bank, and it's a deposit that bank has at their central bank, here for us, at the Federal Reserve Bank, all right? How big is that fraction in the United States? It's about 10%. What does that mean? Well, if your computer, or what we used to have deposit book, says that you have $1,000 in your bank account, actually only 10% of that is actually there, only 10%. You go, whoa. How does that work? Well, that's what I'm trying to explain to you. Let's go on and talk about a deposit. What's a deposit? Well, it's very simple. It's when I take money into the bank. Read your banking contract carefully, and you'll see that when you deposit your money into the bank, it is not your money anymore. You go, whoa, that's not true. Yes, it is. What you've done is you've converted your money into an IOU. Not the same thing. It's not your money anymore. The bank simply says, when you want it, I guarantee you I'll pay you it back. Well, if they only have 10% of your money, how can that guarantee work? That's one of the problems. Okay? What happens then to your deposit? Well, the bank uses it to make a profit, because otherwise, how would they be able to pay you an interest rate? Well, these days they're not paying much of anything, are they? But normally, at least on a savings account, there's an interest that's paid, right? Or you have a term deposit, etc. So the bank has to make a profit in order to give some of that money back to you. Okay? So therefore, what does the bank do with your money? Whatever they want to, within the constrictions of the banking law. They go out and do business. They lend the money out, they buy treasuries, they do things in order to give some of that to you. All right. Let's get deeper into the woods here. Let's talk about a bank balance sheet. What's a balance sheet? Well, number one, it has the balance, right? It's two parts. So a bank has assets and a bank has liabilities, and the two have to be identical. They have to balance. What are a bank's assets? Well, they're not your deposits. Those are liabilities. The assets are the loans, treasuries, bonds, etc., that the bank has invested in. That is an asset to the bank because it pulls money from that. What is a liability? Your deposits. They're a liability to the bank because the bank has promised to pay you back. All right, now we've got enough of an overview to try to figure out how this actually works. So if you want to borrow money, let's say you want to buy a car, so you could go out to borrow $30,000 to buy a car. They look at you, say, hey, Mr. Joe, you're a good guy. I believe you're going to pay the money back. So what they do is they sign a contract to give you the $30,000, and they deposit $30,000 into your bank account. Where does that $30,000 come from? Nowhere. It's made out of thin air. It's called, the technical word, if you really want to know, it's called deposit creation. Okay? The moment that contract is signed, the bank automatically deposits that, creating it out of nowhere, so that, again, the bank is in balance. Because if it just signed the contract, that will be an asset. There's no opposing liability. The liability is the deposit that you now have. Okay? And that, ladies and gentlemen, is how money is created. So all of our money is created by the bank around the corner from where you live, by you making loans. 100% of our money is backed by debt. You know, there's a lot of people who think, well, our money isn't backed by anything. Yes, it is. It's backed by debt. Well, that's sort of a crazy concept because it's not really backed the way we think of it like a gold and the gold backing, etc. Okay. Let me go one step further. This might really drive you crazy. So let's say, I'm going to use a nice round number. Let's say the bank charged you a 10% interest on your car loan. I know it's really high, but let's just say that that's what they did, okay? So the $30,000 loan, and it's a $3,000 interest. At the end of the year, you've had a really good year. You get a great bumper year, and you got the money. You walk in the bank, you say, great, Mr. Banker, I owe you $33,000. So what happens with that money? Well, the $3,000, that's the interest, that's income to the bank. When you pay the $30,000 back, you have just destroyed that money. Poof, it's gone. It came out of nowhere, it goes back to nowhere. That is exactly how it works. Okay? Every time you make a mortgage payment, the principal is money destruction. So that means the debt level has to constantly increase in order to keep that level of money in our society. You say, this Kortsch character I'm watching, he's really nuts. Okay, in the last video, I quoted from a statement from a paper from the Bank of England. I'm going to give you another little quote on that. And remember, this is no different. It's just they happen to have to put this together really nicely in a way that I can quote it easily. And you can look at the last video and it can tell you where to find the quote. Here it is from the Bank of England. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. Ladies and gentlemen, that's how it works. Welcome to our wonderful money system, and I'm Ole Kortsch from the Monetary Trust Initiative. By the way, if you want more in-depth on this, have a look at my book. It's available anywhere, and you can spend several hours going through some of these things. All the best to you. Thanks.